We're going to dive deep into super legal way how Bishop can keep track of all of those debits and credits we talked about last week. Don't forget to work with the so I'm going to run you through these two examples. Now, who's ready for some key accounting goodness? Let's do this. Kicking off with some important parts throughout this video. If you're unsure what credit, you might need to pause at this point. Find a link to
Good morning, everyone. Welcome to class.
Good morning, sir.
I'm doing all right.
Good morning.
Well, I'm so happy that you are online this morning because if you know what happened to me, this morning. I slept away this morning. Woke up 7:50 actually. I hurry up onto the Zoom meeting thing. So anyways, give thanks. Wake up on time. So today we're gonna look at a few stuff today. It'll be longest 3 hours again, 3 hours vigil. First 2 hours we're gonna teach. Next hour you'll be doing some work for yourself as well.
Yeah,
Now we'll look first. Hear me?
No, it's like bola.
So first we're gonna be looking at the effect of profit or loss on capital. And the double entry system for expenses and revenues, right? Remember, as usual, that you must relog in at a certain point in time, all right? When the time expires, okay? Every 40 minutes you have to relog in, all right? Remember that, all right? Smadra, in bed, see me. Anyways, the measure of profit or loss. To an accountant, profit means that the amount by which revenues are greater than expenses for a set of transactions. An accountant, profit means the amount by which revenues are greater than expenses for a set of transactions. Term revenues means the sales value of goods and services that have been supplied to customers. The term expenses means the cost value of all the assets that... Yes?
Which unit?
We are in unit 3, same way. Unit 3.
It is.
3.
Oh, you continue. Okay.
Continuation. So 9 hours that unit 3 taking.
So no did done unit 1 and 2, or what me did there?
We don't need one long time. We finish unit 1 long time. The first unit we do. Alright. We need unit 2 because unit 2 go be a course work. I'm not really do it fully. I might do it, but not really. It's about reading mainly. Yes. The term expenses means that the cost value of all assets, of all the assets that have been used up to obtain those revenues. All right. If therefore we supplied goods and services valued for sale, 100,000 to customers, and the expenses, who that man?
No.
If therefore we supplied goods and services value for sale at $100,000 to customers, that means sell $100,000 worth of goods, and the expenses incurred by us in order to supply those goods and services amounted to $70,000, the result would be a profit of $30,000. See there? Revenues, 100,000, less expenses, 7,000, give you a profit of 30,000, right? On the other hand, it is possible for our expenses to exceed our revenues for a set of transactions. In this case, the result is a loss. For example, a loss would be incurred given the following. Revenues value 60,000, while expenses value 80,000. In this case, the loss is what? 20,000, where expenses are more than your revenues. Right? So when people say they make $10,000, when you have sold something for 10,000, you don't make nothing yet. You know you make as it because you have to take out the expenses first. When you have to take out the expenses for that particular item, or the value, or take out the expenses for making that item, you would have gotten your profit. But what you got originally would have been your revenue, not your profit. All right. You get the profit, you have to take out the expenses. All right.
So, sir,
Yes.
for example, you're saying that, say you're working at a restaurant, right?
Yeah.
And you make some money. You're saying that you're going to take out some money to buy the plate and the fork and the spoon, and then what left is the profit you make?
Yes. Yes. Pretty much. But the plate and the fork, you would not use that those things, because plate and forks are assets, right? Good. But what you do, what you would use in dough is you would use your light and water. You follow me? And gas.
Okay,
Yeah.
that they use at the restaurant.
Eh?
You're talking the water and gas and light that you use at the restaurant.
Yes, dear, yes. But not the plate and so forth. The plate and fork, they would have been factored in otherwise. Right? Because they are expenses. All right? You follow me? Sir, the plate and something are assets, right? But the gas, light, water, they are all expenses. So you take those out. So at the end of the month, you would add up everything that you would have you receive as revenue for the restaurant. Then you subtract what amount of the light and water, the light bill, the water bill, the gas bill, your salaries, your pay, your chef, and so forth. Otherwise, all right. Let's continue. Look at the effect of profit and loss on capital now. Businesses exist to make profits and so increase their capital. Let us look at the relationship between profits and capital in an example. All right. On January 1, the assets and liabilities of our business are assets, fixtures 10,000, stock 7,000, asset bank 3,000, creditors 2,000. The capital is found from the accounting equation. Capital equal assets minus what? Liabilities, right? All right, so the capital is found from the accounting equation. Capital equal assets minus liabilities, as you would have seen previously. In this case, capital is $10,000.
Sir, go get a whiteboard to teach this.
What you say?
Sir, may I say I go get a whiteboard to teach accounting.
Relax yourself, man. When we start do the working out, me use that. Me not do working out now. You follow me?
Yeah.
All right. In this case, the capital is 10,000 plus 7 plus 3, which is will give you this though. These are the total assets, right? 10 plus 7 plus 3,000 here, so it will be 20,000 representing assets, right? And then you would subtract now the 2,000, which is what? Creditors, which is liabilities. And that would give you a figure of $18,000, right? Good. So the capital now is what? 18,000. The capital is 18,000. Now, during January, the whole of the 7,000 stock is sold for $11,000 cash. On the 31st of January, assets and liabilities have become 10,000 fixtures, 14,000 assets, and that'll give you 14,000 assets, right? Minus 2,000 of liabilities, which would that give you that will give you a new capital of what? Anybody? 14,000, sorry, 24,000 minus 2,000. All right, before we go any further, the 40,000 came along for one reason. Why? Because they sold the stock, 11,000 cash, for cash, right? You'd add this 11,000 now to 3,000. And that will give you what? 14,000. Good? So your cash at bank would have increased to 14,000. And then you would have 10,000 plus 14 will give you 24,000. Minus 2,000 will give you a new capital of 22,000. All right? So the capital increased by $4,000 from 18,000 to 22,000. It has increased by $4,000 because the $7,000 stock was sold at a profit of 4,000 for 11,000. Profit therefore increases capital. Yes.
I don't understand one thing they're saying.
Let me go again. All right. First to begin, you get this part. Let me get the 18,000 right there, so. Answer me, please. Hello, respond.
Yeah, the part that I didn't get was you say, oh, we get the 14.
All right. They sell. I said, during January, all of the 7,000, right? Stock is sold for 11,000 cash, right? Good. So that 11,000 cash would have increased their amount in the cash because their cash at bank originally was 3,000 first. See that? And you would add the 11,000 to the 3,000, and that will give you the 14,000. However, your stock basically gone because your stock sold out now. Your stock has been sold out for $11,000. Good? You follow me?
Yeah.
All right. And
yes, following.
Huh? And that's why you get the 14,000 cash at bank, right? You then add this now to the 10,000 to get the total assets, which should now be 24,000. All right?
24,000.
Yes. And you subtract the 2,000 liabilities, which was from before, from that 24,000, and that will give you a new capital of 22,000. All right? Remember that the original capital was
Okay.
18,000. So the new capital is 22,000. That means there is an increase of 4,000 from 18 to 22,000, right? So the capital has increased by $4,000, right? All right. Now it has increased by 4,000 because the $7,000 stock was sold at a profit of
So you
4,000.
really have to get one whiteboard and you do work in them.
No, this part, no, me not.
We
No,
know if you
well,
mix up, there's a
and
way where you have to go try and make it a little clear.
listen to me. Under normal circumstances, I would not be using the whiteboard for this section because already on the paper, why more do that? When I do the calculation with the questions, no, me do use whiteboard, yes, but not with this section, no. Anyways, as I was saying that the stock was sold at a profit of 4,000. Just read it. Just read, you know. How you read the answer? Just read, please. Focus on me read here, so. You get this part already, you know. Because the capital increased from 18,000 to 22,000. That's how you go. Is that obvious? Because you have a new capital the old capital was 18,000. The new one is 22,000. So you move from 18 to 22, which is what? A difference of 4,000, right? Yes. So the stock was sold at a profit of 4,000 for 11,000, right? Now, profit, the point I want to bring to you now is that profit increases capital, all right? Good? So your old capital plus profit will be equal to what? New capital, okay? That's the point here, simple as that. That profit increases capital, nothing else. A loss on the other hand would what? Reduce capital. So capital minus loss equal what? New capital. Profit and loss on sales now. Profit will be made when goods or services are sold for more than they cost, while the opposite will result in a loss. All right? Now, once profits or losses have been calculated, you can enter the capital, you can alter the capital account, right? How often this will be done will depend on the business. Some only attempt to calculate their profits and losses once a year. Others do it others do it at much more frequent intervals. Generally speaking, the larger the business, the more frequently profits are calculated. In order to calculate profits and losses, revenues and expenses must be entered into accounts. And I mean T accounts, all right? All expenses could be charged to one expenses account, but you'll be able to understand the calculations of profit better if full details of each type of expense was shown in these profit calculations. The same applies to each type of revenue. For this reason, a separate account is opened for each type of expense and for each type of revenue. For example, accounts in use may include commission account, bank interest account, royalties receivable account, rent receivable account, overdraft interest account, subscription account, mortgage expense account, telephone account, general expenses account, audit fees account, rent account, postage account, stationery account, wages account, and insurance account. It is purely a matter of choice in a business as to the title of each expense or revenue account. For example, an account for postage stamps could be called a postage stamps account. Postages account communication expenses account, and so on. Also, different businesses, so different expense accounts, right, have different names based on what the business want to call it, right? But it's still expenses. Also, different businesses amalgamate expenses. So, some having a rent and telephone account, others rent, then their telephone and insurance account, etc. Infrequent or small items of expenses are usually put into a sundry expenses account, or otherwise called general expenses account. All right. I mean, 24. I mean. Most organizations use names for their accounts that make it obvious which accounts are for revenue and which accounts are for expenses. However, some don't. Right? When in doubt as to whether an account is for revenue or expenses, you have two obvious indicators to consult. Go again. Most organizations use names for their accounts that make it obvious which accounts are for revenue and which accounts are for expenses. However, some don't. When in doubt as to whether an account is for revenue or expenses, you have two obvious indicators to consult. Watch this carefully, please. The first is on which side the entries are made, are mainly appearing. If, for example, it is the debit side, the account is almost certainly an expense account. All right, as usual, we have 9 minutes to go in this section of the class. Please re-log in as soon as possible when the time expires. All right, remember that, please. Use the same meeting ID. Your admittance might be slightly delayed when you return. All right, but re-log in as soon as the time expires. Okay.
So you can go and talk till the time run out, so I will have 8 minutes, that you know.
Yeah, man, sorry about that, man. Now I was doing something. All right, so quick, first thing, so when if you're wondering whether is a revenue or expenses, to know whether it is a revenue, one thing to note is that you're going to check if the recording is being done on the debit side. If it is being done on the debit side, most certainly it is an expense account. The other indicator is the nature of the business. A commission account in the accounting books of a firm of stockholders is almost certainly a revenue account. All right? Because they are paid by commission. You need to know whether expenses account should be debited or credited with the amounts involved. You know that assets involve expenditure by the business and are shown as debit entries. Expenses also involve expenditure by the business and should therefore also be debit entries. Watch this now. Again, expenses also involve expenditure by the business and should therefore also be debit entries. Why? Because assets and expenses must ultimately be paid for. This payment involves a credit to the what? Bank account or to the cash account. So the original entry in the asset account or in the expense account must be a what? Debit. So both assets and expenses now are what? Debited when they are increasing. Good? If you make sure you get this in, both asset and expenses account are what? When they are increasing, they are what? Debited, all right? Good? When they are decreasing, they are credited. Even where an expense is incurred on credit, the creditor must eventually be what? Paid. The first entry will be to credit the suppliers, that is the creditor's account, and debit the expense account. When payment is made to the supplier, the bank account is credited and the supplier's account is what? Debited. All right. For example, if you pay rent for a $500 in cash or pounds in this case, the asset cash is decreased by 500. The accounting equation tells you that this means that the capital is what? Reduced by each expense. If assets decrease, so does capital. If liabilities increase, capital decreases. Otherwise, the accounting equation won't balance any at all. Expense accounts cert and contain debit entries for expenses. All right. The second part of the entry will either be a credit against an asset account, such as cash, or it will be a credit against a liability account, for example, creditors. All right. Revenue now is opposite of expenses and is therefore treated in the opposite way. Revenue entries appear on the credit side of the revenue accounts. All right. Go again. Revenue is opposite of expenses and is therefore treated in the opposite way. Revenue entries appear on the credit side of the revenue accounts. You have already seen this when you have entered sales figures as credits into the sales account. Thus, revenue is collected together in appropriately named accounts. All right. Where it is shown as a credit until it is transferred to the profit calculations at the end of the period. Move again. Revenue is opposite of expenses and is therefore treated in the opposite way. Revenue, so for expenses, you have a credit entry, sorry, a debit entry originally. But for revenue, your first entry would be a what? Credit entry. Good? For revenue. So revenue entries appear on the credit side of the revenue accounts. You have already seen this when you have entered sales figures as credits into the sales account. Thus, revenue is collected together in appropriately named accounts, where it is shown as a credit until it is transferred to the profit calculations at the end of the period. Consider two, the use of funds to pay for expenses which are used up in the short term, or assets which are used up in the long term, both for the purpose of getting revenue. Both of these forms of transactions are entered on the side of the appropriate accounts. Both of these forms of transactions are entered on the debit side of the appropriate accounts, which would have been expense accounts or asset accounts, respectively. While the revenue, which has been won, is shown on the credit side of the appropriate accounts. So to summarize, the profit belongs to the what? Owners. Revenues increase profits, so they increase capital, and that makes them credits. Expenses decrease profits, so they reduce what? Capital, and that makes them what? Debits. The treatment of expenses is the same as the treatment of assets. Increases in expenses result in debit entries to the appropriate expense accounts. All right. While decreases such as refunds for overpayment of an electricity bill result in credit entries to those same accounts. Revenue is treated the same as liabilities. Increases in revenue are credited to the appropriate revenue accounts, while decreases are debited to the same accounts. In other words, you what? Debit, expenses, losses, and assets, all of these are what? Debited first. Revenue, profits, capital, and debits and capital, they are what? Credited first. As you go forward, you will hear me saying that expenses have a debit balance, assets have a debit balance, while capital have a credit balance. But you will see me, I will explain that to you. Please rejoin as soon as this time is expired. Please. Please rejoin as soon as possible. All right. You pick up from here.